In this video, we'll explore the cheapest house in downtown Toronto, C1 district, to see if it's something worth considering as an investor. So let's get to it. This house is currently the cheapest house on the market right now, currently in the C1 district. It's $1,099,900 with a 17.85 by 51.51 lot, and it is on a busier street. Let's see what it looks like from the outside on Google Maps here. It's nothing pretty to look at, but remember, you're looking at the cheapest property for sale in the area right now, so don't expect much. From the photos, it looks like it has been updated from the inside. It's currently split into two suites, a bachelor and a two-bedroom. It's currently renting for $2,000 for the bachelor and $2,200 for the second floor two-bedroom. So a total of $4,200 a month for the whole house. Now, what I'm going to do is I'm going to plug these numbers into my model. So let's just quickly go through the questions. So no, we're not first-time buyers. We're going to be investors. Yes, the property is in the city of Toronto. We put the address in here. We don't need to know the square footage. Let's say we can negotiate the property down to $1,800,000. Okay. We'll do a 5% down. We'll add in the rent number here, $4,200. And then we'll put in a 5.59% interest rate worth a 30-year amortization. We'll assume that the tenants are paying the utilities. Then we'll add in the tax value from the listing, where you can find here. Let's just assume we never have to put in $1 into the house for the repairs and maintenance, which is impossible, but let's just keep things simple so it helps our numbers look better. So now let's take a look at our summary. Basically, the conclusion is that in order for us to buy the property, we're going to have to pay about $1.12 million in total. We need about $200,000 cash on closing to close on this property on the final closing. And the total amount of cash invested is just over $255,000. If you look at the rental income, you're actually losing about $1,170 per month based on the assumptions. And again, we're not putting in any repairs or maintenance, and we're not putting in any utilities here. So based on today's rates, this is actually a really risky investment. You won't be making any money on this until year 4, and you would have to hold it till about year 10 or 11 before you start making over 4%. If you wanted to sell it in 5 years, you'd be selling it at a loss, so you'll have to wait till year 6 to make a little profit, or a measly 0.88%. For all of that hard work that you have to put in to maintain and manage the house, it would be a lot easier just to park your money into a GIC. So when we stick 6 years into our GIC calculator, we're getting $86,000 compared to our $17,000. So it looks like the GIC wins here again. Keep in mind that this was the cheapest house you can buy in downtown in the C1 district right now at the time of making this video. Now, let's just say that you want to buy this place to move into it as your principal residence, so as an owner-occupier. A quick way to calculate if you're qualified for a mortgage is to take 3 times your housing costs, which should be less than your after-tax income. So in our example, our total expenses were just over $5,300. So let's just round up to $5,500, as they do look at the heating costs, so let's just play it safe. Then let's multiply it by 3, which is equal to $16,500 per month, which works out to $198,000 a year after tax. And if you use this handy Ernst & Young calculator, you can see you'll need to make $135,000 each as a couple, or have a household income of $270,000 to afford this. As you can see, that your after-tax income for each partner will be almost $100,000. If you wanted to pull this off on your own, you would actually have to make $330,000 per year to qualify. How many people do you know that can qualify for this when the average household income is less than $97,000 according to the City of Toronto website? As you can see from these numbers, with these high interest rates, it's going to be extremely difficult for this market to sustain these prices. Here's a quote from Warren Buffett, one of the wisest investors of all time. "Interest rates are to asset prices what gravity is to the apple. When there is a low interest rates, there is a very low gravitational pull on asset prices." That's why prices went crazy prior to March of 2022, before they started raising the interest rates because there was no gravitational pull on prices. But now, with the prime rate at 7.2%, you're seeing a very strong gravitational pull. You can see from the single family home price index price graph for the GTA that the market peaked when the gravitational pull from interest rates were at their lowest in February 2022 at $1.591 million, down now to just over $1.27 million, which is a drop of over $320,000 or over 20%. Now, let's try something interesting. Let's see if it was more affordable before when the prices were 20% higher and the rates were just 2%. To test this, all we have to do is go back into our model and let's increase the price by 20%. And then drop the interest rate to 2%. And as you can see from our cash flow, we would have been paying out of pocket about $4,300 per month. And if we use our 3 times rule for affordability, we need to make an after-tax income of about $155,000, which means a couple making $100,000 each, or a total household income of about $200,000 will qualify for this property. You can see this on the Ernst & Young calculator here. Or if you're a single buyer, you would have to make $250,000 to be able to afford this property on your own. Compared to today's numbers, it was a lot more affordable back then than it is today. And keep in mind that it was at the peak of the market when prices were at the highest. So let's do another thought exercise. So based on today's factors, how much would the prices or interest rates need to drop in order to make it equivalent to the affordability back in 2022? For this, we use our handy mortgage calculator. So I'm going to input the values from our model into the calculator, and I'll show you what to do. So 30 times 12 is we're going to use a 30-year amortization. So that's going to be our end value. So 360, 5.59% is our interest rate. But this is the nominal rate, so we actually need to calculate the effective rate and compound it semi-annually. So don't worry about, if you can't follow along with this, because I'm not trying to teach you how to do this in this video. But basically, in order to do that, you go to payments per year, click on effective rate, click on 12 payments per year, and you click the nominal rate, and that will give you the nominal rate. And then we'll put in the mortgage value of $864,000 into the present value. Future value is always 0. And then we get the payment of $4,919.80. So from the previous numbers, with a 20% higher price and a 2% interest rate, the mortgage payment was just $3,827.92. So let's input that into our calculator again. And what you do is you enter 3827.92, make it negative, enter into the payments. And then now you click on your present value to show that the principal must now drop to $672,248.09. Now, to get the price, since we're paying 20% down, we need to divide this by 0.8, so we get a purchase price of $840,000. So prices need to come down by another 22.2% to make it the same as it was in 2022. So what about the interest rates? All we need to do is simply put the original principal balance back into the present value, which was $1,080,000, and we multiply that by 0.8 because we're taking 80%. So $864,000, and we put into our present value. And then we click on interest rate per year. So if you recall, the interest rate that we have right now is actually the semi-annual rate. So we need to convert it back to the bank rate, the nominal rate, so that we can actually compare apples to apple. So all you really need to do is you need to click Shift, effective rate, click 2, payment per year, and then click on Shift and then the nominal rate. So you get 3.416 as the interest rate. So this is the bank sticker mortgage rate. So then all we have to do is take this number and subtract it by the current interest rate, which is 5.59. So we get 2.174%. So the rates would have to come down by 2.174% to be equivalent in affordability. Based on this analysis, we still have a ways to go before we can go back to the level of affordability we were at during the peak of the market with the lowest interest rates. It might sound crazy, but to me, it's just math. Either the prices gotta give or the interest rates do, or most likely both. A lot of sellers are still trying to defy gravity right now, and it's working in a way because the inventory always falls during the winter months, and there are always going to be buyers who want to buy right now. For the buyers that are buying right now, just know that you're buying at a time when it's the most unaffordable time in our history. Personally, I don't think that the prices will come down to the levels that I calculated, because most likely the interest rates will come down before that happens. So we'll most likely meet somewhere in the middle. If prices come down and interest rates come down at the same time, we can get back to the affordability levels at the peak of the 2022 market. I keep saying this, but keep in mind that we're talking about the peak of the market. So that was the high benchmark that was already set, but we're breaking those benchmarks today. And I'm hearing of bidding wars happening again on houses. So we may still have more to go. It's important for you to understand that people buy mortgage payments, and it's not about the price so much. The biggest decision buyers make is if they can afford carrying the monthly mortgage. With affordability at an all-time low, I don't see how this ends well for a lot of people, especially for those who have speculated with the real estate market, as the buyers will not be there to take over their overinflated houses. I'm sure over time, eventually things will get back up to those prices, but that's something I can't predict. I just know that in the short run, there's going to be a lot of people who are going to be feeling the pain. I don't like to make predictions, but come on. This is the cheapest house in downtown right now, and this is what the numbers look like. You don't have to be a genius to figure out that the prices are way too high. In my last video, I analyzed the cheapest condo in downtown Toronto, and you'd be shocked how much you need to make just to afford an entry-level property in downtown. You can actually watch that video here. If I was able to wake you up to the reality of your numbers and save you from making a terrible real estate decision, then this video is worth it. Share this video with someone you care about that needs to hear this information. Subscribe and stay up to date by hitting the bell button. Until next time, I'll see you in the next video.